2018, we know, terrible year for stocks. Worst at least since the financial crisis. Worst December since the Depression era. This is a new year, though. Why the negative start the way that we're seeing this morning?
Well, you hit on it right at the top. You know, the negative data coming out of China this morning showing that their manufacturing is in contraction for the first time in 19 months. I think their PMI came in at 49.7. That's what the trigger is this morning. You know, last night when I went to bed, the futures were actually in the green. We were probably looking at a modest, positive day to start the year because the focus is going to shift right now. It's going to start to shift towards earnings. We're in that, in that time period right now, but we get this bad news this morning and hence the sell-off.
So we've got a number of things we're watching. They've been the themes in the latter part of 2018 and now into 2019. It's the Fed and interest rates. It's China trade policy, and it's what's happening with earnings season. You mentioned earnings season. China, we got the manufacturing data. The Fed is also a factor at this point. So as we weigh all of those, in the first 2 to 3 months of this year, we're going to have developments on all of those fronts. How important is it to the markets for that?
Very important. Look, it's all the usual suspects, and you hit on them. The Fed, trade, dysfunction in Washington. You got a shutdown right now. The likelihood that nothing's going to happen, legislatively over the next couple of years as we head towards an election season. I'll even add one added thing. You've got a wave of socialism in America today. You just had a candidate announce that that she wants to change corporate structure. That's got to strike fear in the hearts and minds of CEOs and/or shareholders.
Now, as we talk about the developments in Washington, are they as much of a factor in market sentiment as some of those other ones? We know that trade is probably the overriding policy decision right now that's going to affect markets the most. But let's lay it out. How much of the markets are going to be, in other words, how much of a pop or drop do we get from negative trade headlines versus Fed headlines versus economic headlines versus political headlines?
Look, the news cycle will drive the short term for sure. But in the end, stocks will follow earnings. And right now, the biggest concern I have right now is that estimate revisions have kind of plateaued. We kind of stuck up there. And if you think the last time that earnings rolled over, that was around 2014. And lo and behold, 2014, 2015, the markets did pretty much nothing. You add all these negative headlines that you just mentioned, it starts to weigh on sentiment. Right now, stocks are implying negative earnings revisions for next year. So that's going to be a concern, and we're going to have to see how this pans out. The first up to the plate is maybe the most challenged sector of all, and that's financials.
So there is a case to be made right now that the markets are trading at fairly relative value discounts than we've seen over the past couple of years.
I think so. Just before we had the bounce, we were probably under 16 times trailing earnings. And that's a good level of support. But I would put to you that at 13 times, which would imply 2,100, all right? And I'm basing that on $161 for 2018, extrapolating back forward, 13 times, that gets you to 2093. And interestingly, at that level, there's a huge amount of technical support. It also happens to be very close to where we were on Election Day 2016.
So as we talk about the way that things are set up from earnings growth to the overall markets, you said stocks will ultimately follow earnings. So as this earnings season comes up, what is
critical.
It is critical.
It's
then,
critical.
Right?
Yeah.
So what exactly are you going to be looking for in earnings season, given the outlook for the markets and the overall economy?
Financials are discounting a lot of bad news right now. That's pretty clear at this point. And I think what markets and market practitioners are concerned about is what is this yield curve? You actually have a mini inversion on the short end of the curve. And what is this doing to net interest margins for the banks, and what does loan growth look like? If we suffer on the net interest margins but loan growth is okay, I think we'll come out of this okay, because that's probably a good sign.
Do you see a yield curve inversion? Do you see 10-year yields falling below 2-year yields?
I think the good news is that the Fed got the memo. It's pretty clear. I think we all understand, at least I understand, that this was a policy mistake that you saw, in December. When they raised hikes, that was totally unnecessary. And they know it's a policy mistake because within 24 hours, they trotted out on this very network, New York Fed President Williams, to walk back the harsh rhetoric and, kind of put out a statement, we're listening to the message of the markets.
Speaking of listening, if you had one piece of advice, not that the Fed is listening to anybody out there besides their own data, what piece of advice would you give Fed Chair Jerome Powell and the rest of the Fed governors out there as we head into 2019?
Slow down. You have nothing in history to point to. This is the end of an experiment. The Fed has an elevated balance sheet. They'd like to get that down, so I think the biggest issue is, do you really want to start a recession to prevent a recession? We understand the path to normalization. They've got to do this. But I think it's going to have to take a lot longer than they originally had envisioned. And right now, you have deflationary forces out there. You got oil is down well over 40%, from the highs at one point. That's a deflationary force because oil and energy touches everything in the cost chain. I don't see the inflation that they're worried about. And I think it's part of a mindset that goes back to that the United States can't sustain anything greater than 2% growth. And the whole idea of the corporate tax cut was to break out of that. And if you're going to slam on the brakes every time we hit, greater than 2%, we're never going to break out.